All right, we're going to talk about one of the most important, but maybe least understood numbers in your entire financial life. I'm talking about your debt to income ratio, or DTI for short. Now, I know, it sounds super technical, but trust me, understanding this one number can be the difference between getting approved for a big loan or not.
So, are you thinking about making a big purchase sometime soon? Maybe you've got your eye on a new house, or you're finally ready to upgrade your car. If that's you, then you've got to stick around, because this is for you.
You see, when you go to apply for a loan, whether it's a mortgage or car loan, lenders, they kind of zoom in on one specific number to figure out if you're a safe bet. And yeah, you guessed it, that number is your DTI.
Okay, so let's break it down. What in the world is a debt to income ratio? I promise it's way simpler than it sounds. I absolutely love this way of thinking about it. Your DTI is basically your financial breathing room. It's the lender's way of asking, hey, after all your monthly bills are paid, how much wiggle room do you actually have left? So here it is in black and white. Your DTI is the percentage of your gross monthly income, and that's key, your income before any taxes are taken out, that you use to pay off your monthly debts. It's a straight-up comparison of money coming in versus money going out.
All right, you ready to get your hands dirty? Let's actually figure out how to calculate this thing. It's surprisingly easy, and we're going to do it together step by step.
So first things first, what do lenders even count as debt? Well, they're looking at all your recurring fixed payments. You know, stuff like your rent or mortgage, your car loan, student loans, and here's a big one people miss, the minimum payments on your credit cards. What they're not looking at are things that change every month, like your grocery bill, how much you spend on gas, or your Netflix subscription.
And here's the magic formula. It's so simple. You just add up all those monthly debts we just talked about. Then you divide that number by your gross monthly income. Multiply that by 100, and boom, that's your DTI percentage.
Okay, that's the theory. But let's see how this plays out in the real world. We're going to use an example to make this crystal clear. Let's meet Sarah. She brings in a gross monthly income, again, that's before taxes, of $5,000. So that's one half of our equation right there. Now for the other half, her debts. Sarah's got rent at $1,200, a car payment of $350, a student loan for $250, and a minimum credit card payment of $100. You add all that up, and her total monthly debt payment is $1,900. So we just plug those numbers into our formula. We take her total debts, that's $1,900, and we divide it by her gross income of $5,000. And that gives us 0.38. Then for the last step, we just multiply that by 100 to get the percentage. So Sarah's debt to income ratio is 38%. So what does that actually mean? Is that good, bad? Which leads us right to the million-dollar question. Is 38% a good number? Let's take a look at how lenders see these percentages. This chart pretty much lays it all out. If your DTI is 36% or less, you're in the green. That's excellent. Lenders absolutely love to see that. Sarah's 38% puts her in that generally good range, so she's looking pretty solid. Now, the magic number for most mortgage lenders is right around 43% or lower. Once you start creeping up past 44%, it starts to raise some eyebrows, and anything over 50% is seen as pretty high risk. So what if you just ran your numbers and they're a little higher than you want them to be? First, don't panic. The best part about your DTI is that you are completely in control of it. Let's talk about 3 straightforward ways to get that number down. So you basically have 2 main levers you can pull here. The first is the debt side of the equation. You can really focus on paying down what you owe. A great strategy is to attack the smallest debt first, like a credit card, just to wipe that monthly payment off the books completely. The other lever, of course, is your income. Can you ask for a raise, pick up a side hustle? And while you're working on those 2 things, the golden rule is to try and avoid taking on any new debt.
And why go through all this trouble? Well, the payoff is huge. A lower DTI doesn't just make it more likely you'll get approved for that loan. It can also mean you'll get offered much, much better interest rates. And over the life of a mortgage, that can literally save you tens of thousands of dollars.
So there you have it. You know what it is, how to calculate it, and you've got a game plan to improve it. So the only question left is, what's the first step you're going to take to get a handle on your financial picture? Thanks so much for tuning in.